afternoon, everyone. I'm Susan Karmanian, the Dean of the Hamad bin Khalifa University College of Law, and it gives me great pleasure to welcome you to this webinar today that will be looking at the taxation of multinational enterprises with a specific focus on Qatar's transfer pricing rules. This webinar has been in the making for a number of years. And I say that because a couple of years ago, I reached out actually to some of the institutions that are reflected today with our panels about having education in the area of tax law here in Qatar. And a year ago, Tax Authority of Qatar reached out to Hamad bin Khalifa University to talk about ways in which Hamad bin Khalifa University College of Law could help build capacity in the country for understanding what is a very complex area of the law, tax law. Well, at that time, we had limited capacity in terms of faculty, but one of the important hires we've made at the College of Law has been in the last year, where we were very fortunate to have Dr. Alexander Ezanagu, who has put together this entire webinar today, join our faculty. He is an expert in the area of tax law, having done his PhD at McGill University and also an LLM at Cambridge University. So in advance of this session today, first I wanted to introduce you to our newest faculty member, Dr. Ezanagu. And then secondly, to thank all of the panelists. As I mentioned at the outset, this is the beginning of a conversation about taxation in Qatar, and the Hamad bin Khalifa University College of Law believes it should be at the forefront of it, and able to help provide support for the country and to work with the various stakeholders over the upcoming years. So I'm looking forward to this session, and I hope those in the audience enjoy it as well. But again, a big special thanks to Dr. Ezanagu and all the panelists, as well as to Ezzadine here at HBKU for putting together this wonderful webinar. Dr. Alexander, the floor is now yours.
Thank you, Dean Susan, for that introduction and also for the kind words. Welcome to everyone. This colloquium is a very important one as it connects with different aspects of our economic activities, commercial practices, business associations, infrastructure development and financing, public-private partnership, attraction of foreign direct investment, and sustainable development. At a broader level, it relates to theories of taxation and social contracts, law and society, law and development. In December 2019, Qatar introduced new executive regulations pursuant to the Income Tax Law number 24 of 2018. The new executive regulations reinforces the adoption of the arm's length principle in the taxation of multinational enterprises when they transact with each other. It also adopts transfer pricing documentation requirements as recommended by and contained in the OECD's transfer pricing guidelines. The arm's length principle is undergoing reforms globally as it has been adjudged to be limited and effective in the taxation of companies in today's global economy. This is more so when one further considers companies involved in the digital economy. Today's colloquium is sort of organized to discuss the taxation of multinational enterprises, especially within the changing circumstances that we witness today, particularly the base erosion and profit shifting project led by the OECD and global efforts by countries and supranational bodies to find a unified approach to taxing multinational enterprises in a bid to avert trade and tax wars as observed already and feared. What we've done today is to assemble experts on the topic of taxation of multinational enterprises here in Qatar, but also globally. Our speakers and discussants come from the Tax Authority here in Qatar, tax and accounting firms, institutional taxpayers, and policymakers. I will now go ahead and make the introductions. From the General Tax Authority of Qatar, we have both Mr. Yusuf Abdullah Boadu and Mr. Lotfi Salamikeyu. Mr. Yusuf Abdullah Boadi is the head of tax treaties and negotiations at the General Tax Authority. Apart from Mr. Yusuf, we do have Mr. Alamgir Khan, who is Deputy Chairman, Grant Thornton, Qatar. We're fortunate also to have Ms. Braba Anzen, who is a partner at KPMG, but also as the Tax and Corporate Services Department of KPMG. We do have Mr. Lotfi Selami Keliu, who's an expert in tax treaties and international cooperation and works with General Tax Authority of Qatar. We have Mr. Salah Guedi, who's the Director of Tax, Qatar Financial Center Authority. We do have Mr. Kevin McManus, who's the Senior Vice President and Group Head of Tax at Qatar Insurance Group. And finally, we do have Mr. Marcel Kekvliet, who is a partner in International Tax and Transaction Services at Ernst & Young Qatar. Our panelists, our speakers and discussants, as I mentioned earlier, are experts in their field and will be taking us around the conversation today. To our audience who may have questions to ask, we encourage you to post all relevant questions in the Q&A tab on the right side of the WebEx screen, just down there. We do hope that this will be a very lively conversation, and I'm excited to learn and also to hear from our distinguished panelists on how we can actually reform the global tax process as currently designed. The first speaker I would call to give us sort of an overview of the conversation today, actually when we think about how taxation of multinational enterprises occurs in Qatar, is Mr. Yusuf Abdullah Boadu, who is Head of Tax Treaties and Negotiations, General Tax Authority of Qatar. Mr. Yusuf.
Thank you, Dr. Alexander. Thank you, Dr. Susan. The General Tax Authority presents its compliments to you, and we would like to take this opportunity to express our thanks and gratitude to Hamad bin Khalifa University for the cooperation and support for this colloquium. I would like also to thank my colleague, my mentor, Mr. Lotfi Salami. So now for the first slide. According to the given information on the global tax and the economic activities, there are more than 4,000 multinational enterprises groups headquartered in 26 countries, but operating across more than 100 jurisdictions worldwide. As their business operates internationally, so government must act together to tackle base erosion and profit shifting and restore trust in the domestic and international tax system. BEPS practice cost countries about $240 billion in lost revenue annually, which is the equivalent of 10% of the global corporate income tax revenue. The history of the base erosion and profit shifting started in 2013. The G20 adopted a complete action plan developed by the Organization of the Economic Cooperation and Development, the OECD, to handling base erosion and profit shifting due to the aggressive tax planning by multinational enterprises, MNES, which is use the gaps and conflicts of the country's tax systems, creating a threat to them of the significant losses of revenues. That's why the set of measures designed to be implemented as provisions in domestic laws and in the tax treaties. That plans was developed in 2015. The main purpose of the BEPS project is to tackle avoidance strategies by multinational enterprises that exploit gaps and mismatches in the international tax rules to avoid paying taxes. Next slide, please. The package of measures taken to handle the base erosion and profit shifting, it consists of the following 15 actions. Action 1, addressing the tax challenge of the digital economy. Action 2, neutralizing the effects of hybrid mismatch arrangement. Action 3, controlled foreign companies. Action 4, limitation on interest deduction and other financial payments. Action 5, harmful tax practices. Action 6, provision of tax treaty abuse. Action 7, permanent establishment status. Action 8 to 10, transfer pricing. Action 11, BEPS data analysis. Action 12, mandatory disclosure rules. Action 13, guidance of transfer pricing documentation and country-by-country reporting. Action 14, making dispute resolution mechanism more effective. Action 15, developing multilateral instrument to modify the bilateral tax treaties to end treaty shopping and to improve the resolution of treaty-related dispute. Next slide, please. The creation of inclusive framework BEPS. In June 2016, OECD has opened up to interested countries in order to put in place an inclusive framework on BEPS to work on equal footing to tackle tax avoidance, to improve the coherence of the international tax rules, and to ensure a more transparent tax environment. The OECD sent a letter to the Ministry of Finance of the State of Qatar in 2016, inviting us to join the inclusive framework for the BEPS project. Then Qatar has joined as a member in 9th of November 2017. What is the advantage? The advantage of joining the inclusive framework is offering the opportunity to interested countries to participate in decision-making process by attending all the meetings of the Committee of Fiscal Affairs and its subsidiaries bodies to discuss issues related to BEPS on equal footing and to benefit from the plans and programs aimed at strength administrative capacity and to share knowledge and experience with the other countries. More importantly, Qatar participation in the inclusive framework will show the international committee it's committed to increase transparency and the exchange of information on the tax matters and to address the weakness in the international tax system that create opportunities for base erosion and profit shifting. The obligation due to the joining the inclusive framework of the BEPS for the countries. Each country participating in the inclusive framework will be subject to review of the implementation of the minimum standards for Action 5, Action 6, Action 13, and Action 14, in accordance with the conditions set for this purpose, and its tax system will be evaluated in this respect. However, members of the inclusive framework may raise concern about the timelines for the implementation of the minimum standards and may discuss the adjust them in accordance with their specific circumstances. Thank you, and now my colleagues will take over.
Thank you, Mr. Yusuf, for that overview of Qatar's sort of taxation of multinational enterprises framework and as it connects with the global guidelines and global practices. The next speaker, Mr. Alamgir Khan, who is the Deputy Chairman, Grant Thought in Qatar, will sort of be speaking to us on transfer pricing rules, particularly in Qatar, and the challenges of implementing transfer pricing rules for multinational enterprises in Qatar. Mr. Alamgir Khan, you have the floor.
Thank you very much, and good afternoon, everyone. My name is Alamgir Khan, and I'm working with the Grant Thornton as a Deputy Chairman and Partner International Taxation. So today I will cover, in my presentation, I will just take your time, like 10 minutes, and I will cover at least two areas. One is the transfer pricing requirement in Qatar, and the second thing, that's what challenging MNEs can expect while implementing the transfer pricing. So I will first, in few slides, I will cover the rules and regulation in Qatar, and then second, implementation challenges for MNEs. Yes, so we will cover here the background of transfer pricing is that's the state of Qatar's joint Organization of Economic Cooperation and Development inclusive framework in November 2017, as has been explained by our panelists, inclusive which was established and allow interested countries and jurisdiction to participate in the development of BEPS related issues. So being a member of the Economic Cooperation and Development Organization, Qatar, state of Qatar is committed to align with the emerging global consensus on the shared international taxation regulation and requirements. In relating to that's in the end of, at the end of 2018, GTA, General Tax Authorities, has been introduced a new tax law, and in line with the tax law of 2018, on 11 December 2019, another further executive regulation has been introduced, which is in a further explanation of the main law of the tax law of 2018, which require certain specific areas, or which covering specific area which is relating to the transfer pricing implementation, their documentation, and compliance needed by MNEs. So first, I would like to just give you a little bit a definition of transfer pricing. The transfer pricing means the price at which the entity transfer tangible or intangible assets and provide services to related entities. Next slide, please. First, we will cover the transfer pricing methodology. So Article 51 of Executive Regulation in line with the tax law of 2018, in application of provision of the second paragraph, clause 1 of Article 33, which requires that the arm's length principle should be observed and should be applied in accordance with the unrelated comparable price methods. So there are other methods as well, but particularly locally, they preferred, and the first primary method is unrelated comparable price method, which is a price of services and goods which would be applied, should be a transaction between the unrelated and the related party on the unrelated party basis. In case where there is a data and unrelated comparable prices is not available, then the taxpayer should have to submit a formal application to tax authorities for the approval and allowing them to use other methods of transfer pricing, which has been approved by OECD. So the first primary methods which the MNEs are companies are required to apply while executing different transactions with the related parties, unrelated comparable prices. Next slide, please. Second, there is another article, Article 51 and 52, where that's further elaborate. That's in absence of comparable comparative elements for the case under examination. If there is any examination from a tax authority, maybe use a comparable similar activity. So the tax authority can use other comparable similar activity, other income sources and objective evidence available with the authority. That's if there's an absence of comparable elements, so tax authority can give their decision and their guidance on the comparable other comparable source of income. Arm length means that the transfer pricing applied between the two independent entity. So it's the basic theme is that if two entities are executing, their related entity are executing some transaction, so it should be considered that it's similar term should be used, that if it is executing by two independent entities. So the tax regulation further elaborates and that refer that related entity means the entity definition, which has been given in IAS 24 of International Accounting Standards. So we should know that's what's the related entity means by IAS 24, and where we should take care while executing a different transaction with the related parties. Can you give a next slide, please? So I will just give particularly cover here a definition, which is not a person, like just the first steps I will just cover in the next definition. But if the entity and reporting entities are under the same group, so they will have to comply, like they will just within the scope of this transfer pricing association and joint venture of the other entity and groups. Both entity, if two entities are a joint venture and of the same third party, an entity is a joint venture of a third party and other entities associated with the third party. Entities post-employment benefit is also covered in the definition of related parties. An entity is controlled or jointly controlled by a person identified. One means that person an immediate or a close family member. So if they have a significant influence over the entity or a member of the key management personnel of the other entity or of the parent, so it should, the both entity will be, in that case, will be considered as a related parties and will be within the ambit of transfer pricing regulation. The last entity, another definition, that's the entity and any member of the group to which it is a part provides key management personnel services to a reporting entity and parent of the reporting entity. So that's another key area, that if entities providing key management personnel services to reporting entity and parents, so the transaction will have to comply with the transfer pricing requirement. And next slide, please. And now the next text, like first was the methodology. Now we are covering here TP disclosure and documentation requirements. So Article 34 and 33 and 34 cover those specific areas. RB needs to conduct a functional analysis to describe the entity relationship and economic role in the transaction with the related parties, as well as a benchmarking analysis and update the financial data related to comparable transaction annually. So that's if you can see, we have three particular requirements. It's a functional analysis, benchmark analysis, and it should be done by annually. That's the requirement. The next is each related entity shall perform new search for comparable transaction and financial data every 3 years, if and to the extent the entity circumstances remains unchanged. If it is unchanged, so in that case, at least they should have to perform a new search for comparable transaction every 3 years. So that's documentation and disclosure requirement under executive regulation. Next slide, please. A TP and disclosure and documentation further requirement is that each related party need to submit to the GTA General Tax Authority on or before the income tax return filing deadlines, declaration of transfer pricing using a specific form described by the GTA if the total income or assets is equal or exceed to the amount prescribed. It's still like GTA need to announce that specific amount, and that's the criteria in which the entity required to give this declaration. Are one entity of related, are one of the related entities shall have to be a resident outside of Qatar. So there are two conditions that if a country, if an entity is above are equal to that specific prescribed limits, or one of the related entity is resident outside the state. So there are two requirements. One is transfer pricing master file, and the second is TP, a local file. Right now, GTA has not like prescribed some specific form for a local or a master transfer pricing files. So it's automatically, or you can say it's a recommendation from the GTAs to use OECD forms for a submission. The second requirement is that the TP form providing detail of its related party transaction. This form must be attached to annual income tax return along with the audited financial statement. Another obligation is that this obligation shall be effective. Sorry, this obligation should be effective from the tax year beginning and after the date prescribed by authority by the decision of president. We still like that's GTA has to announce on this specific compliance. Can you just next slide, please? The TP file and master file will constitute the basis for that's related to particularly for the examination, that's GTA. So once you submitted the tax return and TP master file, local file, so that's TP master file and local file will provide a basis for examination. The entity shall confirm the GTA that its RP transaction are in line with the arm's length transaction and with the sufficient evidence in support of their claim. The GTA may ask for any further information, and there will be a 30 days time to respond to the GTA request. Despite of compliance with the RP, the GTA may adjust the transfer pricing basis in a taxpayer in case the price applied by the on the intercompany transaction if they believe that it is not on the arm length. Next slide, please. Adjustment to the tax basis, and there are certain criteria. That's where they can just GTA can just adjust the prices, transfer pricing, based on the two criteria which will be applicable, which will be considered while just exercising their powers. So it will be if the transaction is between the Qatari taxpayer and unrelated party in the following cases. In case the parties enter into a said transaction, one of them is enjoy a preferential tax regime or beneficial, and the other case is that one non-Qatari counterparty transaction is established in some non-cooperative jurisdictions. Another condition is here that transaction between head office and permanent establishment, in case one of the party conduct the economic activity inside the Qatar. So that's the two criteria that we'll consider. Next slide, please. There is another requirement which has been indicated in the regulation, that's advanced pricing agreement, which will be issued at some later stage, but it is there that there will be we can just expect further requirement on this. Another limit is a thin capitalization. There is a limitation that deduction of interest on related parties loan to maximum a 3 time of the shareholding equity in the financial statement for accounting period. So the entity may require to substantiate at least the loan advances to related parties that's providing economic benefit. Another requirement is that if its interest is paid by PE to its headquarter affiliated, so it will not be considered as a deductible tax expenses, and it will be considered a non-deductible expenses for tax. Next slide, please.
Sorry, Salamgia, could I encourage you to start rounding up? Okay, thank you.
That's another, like we have just overview. That's a transfer pricing. You will need a planning, you will need an implementation, and you will need a documentation, and then a defending. So that's a 4 module. And the next slide, if you could please, I can just give you a brief. That's what sort of implementation. We believe that there will be overall MNES can face challenges, the resources and efforts which will be required to make compliance with the regulation, data availability and arrangements under the current circumstances, challenges in the policies and reporting system, responsibility and segregation with the existing administrative and review of TP policy. Staff training will be definitely require to just to give us awareness, and headquarter and management services transaction particularly, and framing their procurement structure. Specifically, Qatar specific challenges. We believe that documentation and documentations particularly in Arabic language for some multinational company that will be required. Existing system, like it's not like so much enhanced requirements. That will be another challenge. And professional knowledge, whatever the resources we available here in industry, that's another challenge. That's transfer pricing is a new thing for them. Multi-language services for some of the agreement intergroup, if it is beyond the GCC limits. And another, that's that there will be a primary method than if other jurisdictions allowing other TP methods. So there will be a challenge. A limitation on deductibility of cost based on the domestic regulation. There is a certain criteria for in case of a branch that is a certain amount of maximum deductible expenses can be claimed. So that's I believe that is a challenging area for MNEs. Thank you very much.
Thank you very much, Mr. Lamgir, for that overview of transfer pricing rules in Qatar and also the challenges of implementing transfer pricing rules for multinational enterprises here in Qatar. Our next speaker, Ms. Barbara Enzen, will take us sort of the overview of the OECD's BEPS process as applicable to Qatar and the Gulf Cooperation Council countries, but also would sort of be, just giving us a reaction to some of the challenges that Mr. Lamgir already mentioned. Ms. Barbara Enzen, who is a partner and attorney at law and head of tax and legal at KPMG. You do have the floor now.
Hello, everybody, and welcome to this afternoon session. So what I would like to try is actually to give you a little bit more background and explain, why a country like Qatar is actually introducing all these complex rules. So it started all with OECD. OECD is an international organization which focuses on policies and international standards in a series of topics. So it can be agriculture, safety, climate, but also tax. And traditionally, OECD focused years on the avoidance of double taxation. So to ensure that an entity is not taxed twice on the same source of income. And that's why the OECD model taxation treaties were established and also the OECD transfer pricing guidelines. OECD is also regularly working together with other organizations like G20, G7, and APEC. And, it's important to know that the OECD started to work with the model tax treaties and OECD transfer pricing guidelines 1920, so a long time ago when the tax was completely different. Can you go to the next slide, please? And I think the big change, as Mr. Yusuf already explained, started with the financial crisis. With the financial crisis in 2008, there was a lot of scrutiny on the taxation first of the financial service companies, of the banks all over the world. And then this rolled out or was rolled out further to all multinational companies. So people on the street started to get angry because they realized that they buy a coffee out of money which was subject to taxation. But then they realized that the place where they bought the coffee, let's take Starbucks as an example, it was all over the press, did not really pay taxes in the country they come from because they had very fancy tax planning rules. And I think it's important to mention that they did not avoid taxes. They were just making use of the different tax systems all over the world. And this caused the G20 to contact the OECD and say, we need to do something here because that doesn't feel right. And there the big reaction and activism of the OECD basically started. So we have 2008, 2011, I mentioned financial crisis. People went to the street and told that the tax system doesn't feel right globally. Then the OECD BEPS project starts. I will not go into depth because this was explained already by Mr. Yusuf. The action plan in 2003 and 13 started. And the inclusive framework, I will explain later what this is exactly, multilateral measures, and then in the future there will be it's only the start. So let's say the last 10 years, there was a lot happening in this environment. And this just shortly to give you an overview, what are these action points which have been explained by Mr. Yusuf already, what are they about? So the first group, I would say, of the tax action points, they want to ensure coherence. So they want to ensure that one country cannot implement tax rules which make use of tax rules of other countries, like, you know, that which would allow you to deduct interest twice, so-called double BEPS, or this fancy structure which were the past. So this is coherence, meaning that if a country changes their tax rules, they need to consider the global tax environment, and then they cannot only look at themselves. The other group of measures or action points, it's relies to substance. So what this is about is that, you know, whenever you want to make use of a treaty, of a double taxation treaty, you need to be in this country. The company needs to have substance there, people there, offices there, and not just an artificial letterbox or just a, you know, which was the case on those nice islands all around the world where you had no substance at all but claimed some benefits, tax benefits. The other one, the third one, I would say it's transparency. There it's all about, you know, whatever a company is doing should be transparent. So other countries should know, but also often the public should know. So it's transparency. There is no mean or it should, nothing should be hidden. And I think if you look at all those actions, most of the actions could be, or you have the impression they're actually in favor of the tax authorities of some of the countries. I would say, yes, that's true. But the transparency one, I think it has also a big advantage for the taxpayer. First of all, of course, yes, it's difficult. You need to be transparent, but also the tax authorities need to be transparent. They need to treat the companies fairly, and they need to have clear rules that the company know what to do and how to be compliant with those rules. So I think this is really an important part where I feel it's also something in for the taxpayers. Multinational instrument is a little bit a different action because this is actually an enabler. So the multilateral instrument allows that the tax treaties can be changed in an easier way in order to implement all. And the last one, the digital economy. This is the difficult one, because when BEPS, when the OECD was discussing all those action points, they realized that it's very difficult to deal with the changed environment, with the digital economy, because it's very easy to change IP rights. It's very intangible. And the problem is, whenever this can be, you know, changed from one country to another, it's very difficult to say which country should have the right for taxation. So what OECD actually did, they say, okay, with digital economy, we will deal in a later stage. Okay, so what is the inclusive framework? And Mr. Yusuf has already explained that Qatar is part of the inclusive framework. So the BEPS action plan was established by the OECD pretty much one-sided. So they came up with, there were discussions, of course, but they came up with these points. They realized that the countries which are not member to the OECD, it has a big impact for them, and they also should have a say. So that's why this, I would call it, working group has been established, and Qatar is part of this working group. Okay, now, why is it, and also Ms. Yusuf, I think he touched already a bit, but I would like to dig in a little bit deeper. Why is a country like Qatar interested in doing all that? Because at the end you would say, okay, that's, you know, it causes a lot of new reporting requirements, it's difficult, it's new rules, new taxes. I'm originally from Switzerland, and for me, the situation in Qatar is very, very similar to the situation in Switzerland. Switzerland had not a big issue with attracting, taxpayers. Everybody wanted to come to Switzerland because they had low rates. It was easy. The issue is that countries like Switzerland or Qatar, they are actually forced to comply, because all the other countries which have maybe a higher tax base, they will say, okay, that's not correct, because Qatar has low taxes or Switzerland has low taxes. The companies try to shift their profit artificially into these countries. So what happened is that the international community, OECD, they established blacklists and say, okay, if you have certain revenue or certain expenses coming from those countries, you are not allowed to deduct it, or we will introduce withholding taxes towards these countries. So the international environment actually forces to be compliant with BEPS and to be part of these discussions. And of course, it has also the advantage that, you know, if you are compliant with international standards, then it's easier for the companies to trade with those countries. So that's the general, I would say, general direction. So what did Qatar already do? I would say Qatar, probably together with Saudi Arabia, was a very fast mover. I would say they negotiated extremely well because they managed to stay clear of all the blacklists. There was certainly, for a very short moment, they were on a Dutch blacklist, but really very short. But they managed very well, so they did not land on all those blacklists. As we have already mentioned, so Qatar joined the BEPS inclusive framework, so this working group I have mentioned before. Qatar has committed to adopt the minimum standards, so action points 5, 6, 13, and 14, has signed the MLE, which will have an impact on the double taxation treaty signed by Qatar, because they will now change in order to be compliant with those rules. Qatar has already implemented CRS FATCA. I think it's probably it's a exchange of information by the banks to ensure that nobody can hide money. Thin capitalization rules have been now introduced with the new executive regulations, and as we have heard before by Mr. Khan, that detailed transfer pricing declaration is expected to come. So it has already been implemented with executive regulations, but it needs to be kicked off, or it needs to be done. Where does this stand in connection with other GCC countries? As I've mentioned before, so KSA, I think the situation is a bit different because they have quite an advanced tax system already, and Qatar, they were the first movers. So they were from the beginning very active. They have implemented a lot. Then I think second came Bahrain and UAE. So they were a bit slow. So they landed on the blacklist, but now they also have introduced a lot, also economic substance regulations, so to ensure that they got away from those blacklists. And then we have Oman and Kuwait. They are still a bit behind. I think this has certainly to do with their parliament. So it's much harder to implement new taxes or new regulations. So they will also come, but they are probably a bit on the later side. Maybe just have a short look into the future, and then I will hand over to the next speaker. Can you go to the next slide? To the next, maybe. Yes. So what I mentioned already before, that when those action plans were established, it was already clear that this would probably not be enough, because they were not able to really cover the new, the new digital area. And it was already clear then that the OECD mentioned we will deal with this later. The problem was that a lot of countries, they didn't want to wait, because the big need in introducing a digital taxation, because they felt that the consumers are in their country, similar to the example I brought with the Starbucks, but the taxes landed in another country, and they were not happy with that. So they wanted to introduce a taxation of the digital services. Then also the US moved, so they went forward with a tax reform. And instead of unifying the entire tax system, actually BEPS, at the first step, actually the opposite happened, because every country started to introduce something. It was not aligned, and this was, of course, a big problem. So that's why OECD now tries to reestablish a consensus between the world and also tackle this next stage of the digital taxation. Can you please go to the last slide? And I'm sure that the speakers after me will comment further on that, because this is now really, really big change. So one BEPS 2.0, it's called, consists in 2 pillars. So the pillar 1 should actually regulate on a worldwide basis where a certain profit has to be taxed, which country has the right to tax, similar to indirect tax rules. There you always know you have a certain service, and you know which country has the right to tax this service. And this should also happen now in the corporate income tax world, to say, okay, which country has the right to tax, and also some sort of nexus rules which can be explained a little bit like permanent establishment rules. So meaning what kind of activities will lead to a taxation in a certain country. So that's pillar 1. And then we have pillar 2, and this pillar 2 could have a huge impact on countries like Switzerland and also, of course, Qatar. This will be a global minimum tax, so that big multinationals, and the big multinational is usually seen as a group of companies with an income of over 750 million euros, will have to show a global minimum tax. It's not yet clear what the percentage will be. Discussions are around 14, 12%, something around that. And the state, I think, if my understanding is correct, in October there will be the next round in OECD and in the inclusive framework to discuss exactly how this could look like and what could be this rate. So as you can see, there will be a lot to come. And with that, I would like to give the word to Mr. Lotfi, who will be the next speaker.
Thank you, Ms. Barbara, for that sort of overview of the OECD's BEPS process. I'd like to call Mr. Lotfi Salam Khalil, who is the expert of tax treaties and international cooperation at the General Tax Authority Qatar, to give his own presentation. Thank you, Ms. Barbara. Mr. Lotfi.
Thank you. Thank you, Mr. Alexander. I just wanted to reply to some of the questions in the first presentation of Mr. Alamgir. The thresholds for the transfer pricing statement and for the master file and local file are respectively 10 million and 50 million. The English will be allowed for the submission of the documents and information. Moreover, the electronic platform, Dhariba, the new electronic platform, will be displayed both in English and in Arabic. The information and documents required in the master file and local file are exactly the same as those recommended by the OECD. And the decision is already signed, and it will be published and distributed in a short time. And we moved the entry into force of the whole decision for the fiscal year 2021 due to the COVID-19 pandemic, and this will not be counted in my 10 minutes. Thank you very much for giving me the opportunity to speak on this subject, which is of great importance to both administrators, entrepreneurs, and researchers. The post-action plan on base erosion and profit shifting requires, in my humble opinion, 2 complementary academic approaches. The first one is to study and analyze the implications and results of the participation of the state of Qatar in the inclusive framework on base erosion and profit shifting, and of its commitment to implement its action plan. I remember in this regard that this participation took place in very specific circumstances to avoid the status of non-cooperative jurisdiction, which will trigger a range of foreign defensive measures, including tax measures, tax defensive measures, not to mention the reputational damage. This was not the only pressure on the tax department of the Ministry of Finance that existed at the time of the state of Qatar's accession to the inclusive framework. Another pressure, internal this time, was exerted on the tax department by Qatari entities who urged the tax department to work on a legislation on country-by-country reports and on the activation of exchange relationships with competent authorities of other jurisdictions under the Multilateral Competent Authority Agreement on exchange of country-by-country reports, so that they, in their capacity as ultimate parent entities of multinational enterprise groups resident in the state of Qatar, fulfill this reporting obligation in Qatar and not through surrogate entities reporting to tax administrations of other countries. It is in response to this domestic request that the state of Qatar has adopted legislation on country-by-country reports, which legislation is expected to be amended in the near future in view of the amendments to the template legislation of the Organization for Economic Cooperation and Development, and which is currently under review. We will see later that country-by-country report is called upon to play a fundamental role in the implementation of the new Pillar 2 rules. It would therefore be extremely useful and interesting to organize a conference dedicated specifically to the amendments currently envisaged to the template legislation on country-by-country reports. Academic research should, in my opinion, enlighten the General Tax Authority not only on the legislative, regulatory, and administrative means to be implemented to achieve the commitments made, but also inform the General Tax Authority on the potential benefits that Qatar could derive from the inclusive framework to protect its own tax base, as well as to lower the cost to be incurred to protect the tax base of other countries, economic and administrative costs included. It is not only a question of whether the state of Qatar is actively contributing to the international effort to combat base erosion and profit shifting, but also whether it is deriving some benefits of such an effort. The BEPS action plan should not be seen as a compulsion to endure, but as an opportunity to take advantage of it. In any case, what I think is important to point out is that there is no, strictly speaking, a post-BEPS action plan on base erosion and profit shifting. In this regard, I prefer the name used by Barbara, BEPS 2.0, which more precisely reflects the situation. The action plan, which was very fruitful in actions and measures at the time of its establishment, has not been abandoned. There is no intention of compressing it or amputating any of its components. On the contrary, we have experienced it with the multilateral instrument of the new Action 15 an acceleration of the implementation of BEPS measures, covering both measures reflecting minimum standards and other measures not reflecting minimum standards, such as measures relating to the permanent establishment status. It is also expected that other minimum standards will be added to those which currently exist, or at least that the minimum standards will be extended and broadened. For example, work is currently underway to have the Action 14 minimum standard on international tax dispute resolution and mutual agreement procedure also encompass the bilateral advanced pricing arrangement. Another subject for which we would like a conference to be devoted to it, Mr. Alexander and Mrs. Barbara, or rather two conferences, in case we would also like to discuss tax arbitration and the models and options offered to the state of Qatar in this matter. In short, the action plan, which with its innumerable measures of substance, coherence, and transparency, still has a bright future ahead of it. It is by no means abandoned. Some actions are even revisited, revised, and updated, thereby placing more constraints and burdens on states and their tax administrations. The new proposals and solutions under the two pillars currently being developed to face the tax challenges posed by the digital economy, and therefore are therefore not intended to replace the action plan, but to complement it. It is good to know that these proposals and solutions, this architecture, which is completely new, undoubtedly innovative, and cruelly ambitious, is developed under the aegis of the inclusive framework which laid down in the past the action plan. In addition, some of the most important rules of the new proposals and solutions will be based in their very operation on a BEPS action, namely Action 13 on country-by-country reports. So the interaction exists between the BEPS action plan and the new proposals and solutions. As a result, the constraint that the state of Qatar has suffered in participating in the inclusive framework is not about to be eased. It is called upon to be heavier. And academic assistance seems very important, even crucial, because we are at the very beginning of a new process, a process that calls for reflection, decision, and adaptation. This is why the study and analysis of the participation of the state of Qatar in the inclusive framework and the BEPS action plan should be done with the aim of refocusing this participation to ensure that this participation does not, or not only be with the aim of complying with the agreed standards and rules, but also with the aim of maximizing the profits to be drawn from these standards and rules and minimizing the costs to be incurred by these standards and rules. Therefore, I strongly encourage you, dear teachers and students, to pay particular attention to this aspect of the discussion on the subject. The characteristics of the state of Qatar, its political, administrative, and financial organization, its geography, its economy, its demography too, as well as those of its immediate neighbors and of its most important economic partners should all be taken into account in the lessons to be drawn from the state of Qatar's participation in the inclusive framework. How can one ensure that the state of Qatar benefits from such participation? What is, above all, the room for maneuver available to the state of Qatar? What are the possible reforms to be introduced in the legislative, regulatory, and administrative fields? What are the corrections to be made to the reforms already introduced? Since 2017, the Ministry of Finance and the General Tax Authority have made a considerable effort to convey the image of a country concerned with respecting its international commitments in terms of transparency and fight against fraud and evasion. But we also need to reassure investors and businesses through information, communication, and concrete legislative, regulatory, and administrative reforms that consolidate the rights of taxpayers and create an environment conducive to investment and business. The General Tax Authority is working on a number of reforms: decision on the direct application of tax treaties, draft decision on the bilateral advanced pricing arrangement already finalized, guidance on the mutual agreement procedure already reviewed with the OECD, decision on tax exemptions for priority economic sectors and new businesses, taxpayer charter, etc. And above all, strengthening the rights and guarantees given to taxpayers. The second approach of the scientific community would consist not in evaluating past commitments and their future implications, but also in considering the future context, as Barbara said, the future environment which will emerge from the new proposals and solutions developed to face the tax challenges of digitalization of the economy. This is precisely the second part of my intervention on the post-BEPS action plan. And I must admit that the Qatari position is a mixed one. The solutions of Pillar 1 and Pillar 2 are developed in a spirit of consensus, of course, but they are prepared in haste. The work is progressing at a breakneck pace. The G20 press releases each time stress the importance of moving the work forward. It gives the impression that there is a serious, urgent, important problem and that we would like to find a final, radical solution as soon as possible. The new solutions contribute, as announced, to the establishment of a globally fair, sustainable, and modern international tax system. I do not trust these professions of faith. We are also told that the COVID-19 pandemic has had an impact on the work to address tax challenges related to the digitalization of the economy. The pandemic is accused of having posed obstacles and the pressures on work to finalize these solutions. I have a doubt about it. On the contrary, I think that the pandemic has accelerated the work, especially in their most technical elements. The building blocks. Meetings were held remotely at a very rapid pace. This allowed the working groups to make significant advances in the technical elements and in the clarification of their practical implications. What has delayed the work is the position of the United States of America on Pillar 1, and it is also the embarrassment, if not the dissatisfaction of some countries with the complexity and some features of Pillar 2. But in any case, the pandemic has not had a noticeable impact on the progress of the work done so far. On the contrary, the serious economic and financial crisis which followed and which hit countries hard, and the tax cuts that these countries have granted to businesses and households have encouraged many of them to accelerate work on Pillar 2 to recover the tax losses they suffered, because many countries see the new solutions as a way to recover and compensate for tax losses. In short, Pillar 2 mainly has become a lifeline for some countries and a veritable crusade against multinationals accused of engaging in offshore arrangements guided by tax avoidance. The message explicitly and implicitly conveyed is that before the end of the year, there must be a concrete result. Personally, I call it the tendency to accelerate. It is the same haste that guides the teams of the Organization for Economic Cooperation and Development in discussing and finalizing new solutions. As a result, the inclusive framework is called upon to move the work forward. The pillars are therefore a continuation, a complement to the action plan, but not a substitute for the action plan. The Qatari scientific community should, in my opinion, pay special attention to these solutions and to the position that the state of Qatar is called upon to take on these solutions. The interest of the General Tax Authority in scientific studies developed or to be developed on this subject is obvious, because they undoubtedly help to forge and shape the international tax policy of the state of Qatar and his speech and action in the OECD. I would like to have a few words, and I will conclude on the characteristics of the solutions developed. These are consensus solutions. A consensus is ardently desired before October 2020. Consensus by whom? How is it obtained? These are two fundamental questions to which the attention of the scientific community must be drawn, because they relate directly to the organization, functioning, and decision-making procedure within the various organs and bodies that make up the Organization for Economic Cooperation and Development, as well as its interaction with other organizations, including regional organizations. Arab or Islamic organizations are notably absent. I invite Mr. Alexander to consider organizing an event on tax coordination between Arab and Islamic countries, and in particular tax harmonization between Gulf countries. And I sincerely believe that Pillars 1 and 2 will be a serious catalyst for such awareness. The much desired consensus should not fool us. The new pillar solutions will be suffered by a few countries. Some of these countries have made a considerable effort to comply with the BEPS action plan. This effort will be of no help to them when the time comes to implement Pillar 2. What I can say at this point is that consensual views and differences have emerged from the work, but it is clear that certain questions, both technical and political, are still pending. These are also global solutions. Perhaps this is why those solutions pose an undeniable problem of complexity and repeated requests for simplifications from members of the inclusive framework. Thank you, and sorry for taking too much time.
Thank you, Mr. Lutfi, for that very passionate presentation. I note all the assignments directed towards me, and I shall come back to you on them. Without wasting any further time, we're actually quite behind schedule. I would invite Mr. Salah Guedi, who is the Director of Tax at Qatar Financial Center Authority, to sort of give us his view on the presentation so far and to speak to us about some of the topics that have been discussed today. Mr. Salah.
Thank you, Dr. Alexander. Good evening or good afternoon, everyone. I'll try to be very short and succinct in my presentation. So my name is Salah Guedi. I'm the Director of Tax at the Qatar Financial Center Authority. Before that, I used to work in the Ministry of Finance as a Senior Tax Advisor. So this is just to say that I will be giving you the perspective of someone who is still involved in tax policy matters, and the reaction of someone who had worked for some time on some of these issues. So this is my I would say my starting point in this discussion. I noted very carefully what my previous colleagues, my previous speakers have said, but I think just to give some context to what I will be saying, it would be helpful if we start with a quick recap of the international tax landscape. That will help us understand the different positions that the state of Qatar took in the past and the kind of challenges that policymakers are facing at this stage, including the General Tax Authority and the Qatar Financial Center Authority as well. So I'll go back quickly to the financial crisis. I mean, you remember what happened there. Huge stimulus packages were decided by governments. There is a clear and urgent need for additional money. So while the international community basically and literally went on war, they identified two evils at the time, so tax evasion and tax avoidance. It all started in 2010 with the US enacting the Foreign Account Tax Compliance Act, FATCA, and then quickly after the OECD followed. In 2009, the Global Forum on Transparency and Exchange of Information was established, and Qatar was it was the first Gulf and MENA country that joined the forum. Then from 2010 to 2013, a lot of work has been done. And here I just want to note the pattern that the OECD and the international community have been working according to it. And we start by identifying or defining the standard. Then we establish a body that will oversee the implementation and review of the standard, and then also you have a development of a body of rules and processes such as the peer review process. This happened with the exchange of information on request in 2009. It happened again with the exchange of information, the automatic information CRS, and it's happening once again in relation to BEPS. So that's how things have been evolving. What does this mean, or what did this mean for from a tax policy perspective for a small jurisdiction like Qatar? The keyword, and I think I'll be using one of the words that Lotfi has used, is to adapt. So we tried to adapt at the time, and we followed, I would call it passive adaptation, I would say. So what we try to do is basically stay away as long as as much as possible from any risk of being, adversely assessed by the OECD and other international organizations, and trying to be compliant as much as possible. The whole idea is about avoiding the risk of the non-compliance risk and its impact on the reputation and the attractiveness of the country as a hub for investment. Then, the question we can ask at this stage is, how did that work? How well did that work for us? Was this approach sufficient? Probably that's an area where we think about, and I think I know that Lotfi have touched upon a little bit on it, but I just want to give two examples that really summarizes the way Qatar, or the approach Qatar has taken in relation to all these challenges. In relation to the common reporting standard, automatic exchange of information, the option taken by Qatar is to go for a non-reciprocal exchange. So basically, as I said, we want to be compliant. I don't want to receive any information, but I'm happy to give whatever information is requested by my treaty partners. And the aim is always stay compliant. The other example I can give in relation to BEPS is the work that has been done on the multilateral instrument. even though there is a lot of possibilities and a lot of options for a country like Qatar, taking into consideration its tax treaty policy, taking into consideration its status as a capital exporting versus a capital importing country, taking into consideration as well all its characteristics, etc. There were a lot of opportunities to adapt and opt in or opt out, depending on the case, many of the provisions in the MLA. And what was done is just to stay, to keep a minimalist approach and only focus on the minimum standards. So my question again, is this sufficient? Obviously, no. Clearly, no. We can say it. I think it has been noted by Barbara, Yusuf before her, and then Lotfi again. This is not the way we should move forward. So what I'm suggesting to do is to move away from this passive adaptation to a more active adaptation. So to be actively, to adapt yourself and your policies. Try to, I think it was mentioned as well by Lotfi, is try to identify the opportunities that are offered by these new rules and try to make the maximum of it in your tax policy. So the idea would be basically to identify your priorities, what you want to do in terms of attracting investment or in terms of your tax policy, and most importantly in relation to international standards, instead of simply and passively being compliant with them, try to embrace the policy objectives that were behind those standards and try to implement them and benefit from them. What does this mean in practice for the state of Qatar? I guess it means that probably a full review of the tax regime, a full review particularly of the exemptions, a full review particularly a clear and very thorough reconsideration of the territoriality of the tax regime. Is it still applicable? Now look at what, quick word on BEPS 2. I like also the word BEPS 2.0, because remember what started with an action that is supposed to address the challenges in the digital economy. Then we discovered actually it's digital economy is not something that you can really ring fence and isolate from the economy. Actually, we discovered that everything is digitalized, and we talk now about a process, digitalization of the economy. And we ended up, we started by, well, in the beginning, we started by saying, yeah, digital economy is posing a lot of issues from an international tax perspective. We need to address it. And then we ended up in a situation where basically we can address all BEPS issues from the perspective of digital economy. And that's how why we are talking about BEPS 2.0. And the I would call it kind of tsunami or earthquake that is brought by Pillar 1 and more important Pillar 2 would mean that tax policies like policymakers like ourselves need really to think carefully and we would like to attract investment. We are happy to provide tax incentives. We're happy also to comply with whatever requirement in relation to substantial economic activity. But if Pillar 2 is applied and a minimum taxation is introduced, it doesn't make any sense, because whatever tax you give up here in Qatar, it will be collected by another country, which make any tax incentive completely void and useless. And therefore, this raises the question: how can I, or how should I design my investment incentive approach? I'm cautious about time. There is one word I need. It's still about transfer pricing. So, but I had to say at least one word about transfer pricing approach from the QFC perspective. The QFC is set up to attract investment, and basically the balance that we try to strike is between two things. One is to manage the taxpayer burden in relation to their obligations, and particularly in relation to transfer pricing. We understand, transfer pricing study is an expensive thing. Filing is very expensive, so we need to make sure that we take care of that. But at the same time, we need to give the tax department enough information and enough material to check that related party transactions are properly checked. So that's why what we did not want to introduce specific transfer pricing documentations. But in the course of an inquiry, and by the way, I can tell you safely that more than 90% of our inquiry issues is about transfer pricing transactions. Probably Marcel and Barbara can confirm that for you. So we look closely to those transactions, but when we look at them, we ask for everything. That's the way the KFC has been dealing with this. We try to listen to our investors. We try to address their concern, but at the same time, we try to make sure that the regime is properly administered. With this, I'll finish and hand over to Marcel and Kevin. Thank you.
Thank you so much, Mr. Salah. I just go straight to Mr. Kevin McManus, who is the Senior Vice President and Group Head of Tax at Qatar Insurance Group. Mr. Kevin.
Thank you, Alexander. So I will try to keep my comments as short as possible. I'm going to provide some level of a perspective of an in-house person working in business and how I would look at these rules. I suppose transfer pricing in theory, the arm's length principle has been in existence in Qatar, both in the state and in the QFC since 2010. What we have at the moment and what was discussed earlier is a reset of the rules and kind of building them out more than what was previously the case. It's placing clearly additional burden on business. So I'd start off by saying that for certainly transfer pricing, it's looking at multinational enterprises. They operate already in many different jurisdictions. They are familiar with transfer pricing. If we look at how, if we look at the Qatar tax landscape, in many respects, because of the low tax rate here, there's a motivation for multinationals to have higher profits here. Rather than more expenses and consequently lower profits. There's other factors that also need to be taken into account. Qatar applies withholding tax on most cross-border payments, and accordingly, the benefit of being able to support a higher amount of costs being pushed into Qatar is not always there. I think when we look at transfer pricing, it's one of the most subjective areas of tax. So we're looking at a transaction between two related parties. What is the value of that transaction? How do you determine it? Now, there are clearly guidelines that the OECD has put out that are very helpful in many respects, but there is still latent subjectivity in there. As an in-house tax person, when I look at transfer pricing, I want to know that when we determine the price of a transaction between our related parties, whether it's for services or in our case, reinsurance or investment management, that I have reasonable certainty about the expectations that are placed upon us as a business by the tax legislation in a given country. So it's incredibly important that there is clarity, both in terms of the legislation and clarity in terms of the methods that can be used to support your transfer price or to determine your transfer price, and the extent to which that will meet the expectations of the tax authority. So certainty of tax position is what all corporates want. They don't really want surprises. They don't want to receive an assessment 2-3 years down the line, which will not be well received internally. I do appreciate that there's reference to APAs in Qatar tax legislation. I think that's very, very sensible and will be very much appreciated by corporates. If I look at some other aspects, I know Salah, you mentioned that transfer pricing is expensive. It is an expensive effort, both in terms of time and effort. It's something where we want to be able to leverage the work we do for one transaction across as many geographies and as many companies as possible. There's also a recognition that while you may have large value related party transactions, many related party transactions are relatively small, or you could have an entity within your group that is relatively small. So the point I would bring out there is there needs to be recognition of the cost versus benefit of transfer pricing documentation. You want to minimize the impact on a corporate in complying with legislation. There should be sensible de minimis rules, sensible safe harbors and carve-outs. so that you really do focus your efforts and your legislation and the expectations and the demand on a corporate on the highest value transactions. Probably one of the last points I'd bring out is on benchmarking. So benchmarking clearly is where we look at gathering comparable data about comparable companies providing similar or same or similar type services. One of the main challenges we have in the Middle East is the lack of regional data. And accordingly, if you're trying to benchmark a transaction involving one party in the Middle East, you normally have to use comparable data from outside of the Middle East. When we look at a tax authority, there's also an important distinction because a tax authority in theory has their own benchmarking data. I think it's helpful, the comments that Lutfi made about English being accepted. Again, multinationals, a lot of their documentation, a lot of multinationals will already have documentation in English and they want to be able to leverage that. A few comments on Pillar 2. So we're looking at BEPS 2.0. Pillar 2 it's clearly obviously still underway. Lutfi made some comments about the speed at which the blueprint, which is due out in the next 10 days, has been worked on. I would share those comments. It's been moved too fast. There realistically isn't ample time for governments and stakeholders to provide their comments. Pillar 2 has the potential to be extremely impactful. A key tenet of taxation historically is that tax is a sovereign right. Each country can dictate their own tax rules. In the last 10 years, we've certainly seen many areas where that sovereign right has been eroded. Salah mentioned about FATCA in 2010 when it was announced in the Time Act. That was one key example of, if we don't like your rules, we have a stick to beat you with. And we have exactly the same with Pillar 2, which would impose a global minimum effective tax rate on multinationals. For multinationals based here, particularly if you're a government-owned entity, listed entity owned by Qatari nationals, you don't pay tax, and accordingly, your global minimum effective tax rate is much lower. I would echo Lutfi's comments that this is a key area of focus within the community. Everyone on this call today should be very mindful of what Pillar 2 is and how that could impact the entire country's tax legislation, the attractiveness of Qatar from an inbound investment perspective, linking to Salah's comments as well. I'll pass back over to you, Alexander.
Oh, thank you, Kevin, for that intervention. We'll go to Mr. Marcel Calculet, who is the Partner International Tax and Transaction Services at Ernst & Young Qatar, to give his own intervention.
Thanks, Alexander. Thanks, and thanks for all the presenters to share their thoughts so far. Conscious of time, I think we have 6 minutes left. It's incredible that we simply move on with BEPS 2.0 while 5-6 years ago we were still wondering whether BEPS would see the light and whether tax authorities around the world would put their, let's say, arms around it and implement. And if we see where we are now, I really must make a compliment to Yusuf, Salah, and Lotfi with their colleagues from both the GTA and the QFC, how they embraced, let's say, the BEPS project from a tax authority perspective and moved on in a very fast-paced, much faster than countries surrounding us here in the GCC. And I think that it all comes back to creating certainty for taxpayers here in Qatar, specifically the outbound companies, the sovereign wealth fund, and the big multinationals in Qatar. And I think that's really important. And we've heard that throughout the presentations, that creating certainty, creating clarity, and listening to taxpayers and giving them the rights that they really have. I think that's the most important thing also dealing with our clients on a daily basis and our interactions with the tax authorities. And although the transfer pricing legislation came out recently, and the executive regulations came out recently, I'm very happy with the comments made by Lotfi, giving some clarity, and hopefully they will announce publicly very soon. I think that's the path going forward as well for both the GTA and the QFC to work together with taxpayers and advisors here in Qatar to make sure that we are participating in the debate and also giving their inputs and sharing our inputs, and particularly around Pillar 1 and Pillar 2. I fully agree to the comments made on the pace and probably also the interruption that COVID caused, and now probably also the acceleration that the OECD and the G20 want to put forward. I think October and November will be very important to follow what's happening around the G20 summit with the ministers of finance and later on the prime ministers in what they discuss and what will be the way going forward. And I think also to ask a bit of feedback from both Lotfi and Salah, if I may. The big question mark, of course, is, okay, we have a headline 10% corporate income tax rate here in Qatar. There are exemptions for Qatari-owned companies. So what will be the impact? What are they looking at right now? What are their thoughts when it comes to the tax rate here in Qatar, but also the exemptions given to Qatari-owned companies? And then secondly, also, what do they know, and can they share some input on potential carve-outs? Carve-outs, for instance, or for a sovereign wealth fund or for a pension fund. I think I fall into repetition if I continue, and we have 2 minutes left. So, if I may, Lotfi and Salah, can you share some thoughts, some thoughts on those questions?
Thank you greatly, myself. So we do have some questions that have been asked, but I think I would let Mr. Lotfi and Salah sort of respond to some of the questions that you've raised, and we'll see if we have enough time to just go through the questions quickly that we have. Mr. Salah, please go ahead.
Thank you, Dr. Alexander. Thank you, Marcel, for the question. As I mentioned in my brief presentation, we are, by the way, we are working very closely with GTA as well. We are very aware of the challenges that are posed by Pillar 2 and what does it mean in terms of designing the exemptions and the tax burden in general, including the rate. I will give you my personal view, because this needs also coordination, but my personal view is we need to clearly review the whole regime. We really need to review completely the regime and agree on what we want to do in terms of, tax policy objectives and attractiveness of the tax regime in itself, and whether or not it still makes sense to give the exemptions that are given now and to keep the same tax burden. I fully agree that tax exemptions need to be reviewed, including the way it is drafted particularly in the state law in relation to the exemption of Qatari nationals, but also in terms of how they will fit with the new reality of BEPS 2.0. In terms of carve out, it would make sense to carve out sovereign funds or sovereign investments, and that's what I'm sure Dr. can give you more information on that. But again, we have to make a full assessment of the impact of BEPS 2.0 on the Qatari tax policy and decide on that basis. So I hope I answered at least partly to the question.
Mr. Lotfi, if you could just briefly respond.
Thank you. I want to echo what has been said. Pillar 2 focuses on the remaining BEPS issues and seeks to develop rules that would provide jurisdictions with a right to tax back, where other jurisdictions have not exercised their primary taxing rights, or the payment is otherwise subject to low levels of effective taxation. Pillar 2 is based on the assumption that the BEPS action plan has not been able, despite its fruitfulness in rules and measures, to solve all the problems for which it was established. Some countries are not entirely satisfied with the results achieved so far by the BEPS action plan. BEPS issues still persist in their eyes. These remaining problems require a new solution. Pillar 2 is that solution, but for me, it is a source of unease. Digitalization of the economy appears to be a secondary issue, as Salah said in Pillar 2. Although it was designed and developed to address the challenges posed by the digitalization of the economy, the little connection between the design of Pillar 2 and the digitalization of the economy makes me personally think that the intention was to seize an opportunity to reflect on the tax response to the digitalization of the economy, to deal with a completely different question: reform of the taxation rules of multinational enterprises. Because Pillar 2 targets not companies that carry out digital activities, but potentially it targets subsidiaries, branches, payments paid and received when their effective tax rate is below a certain threshold to be determined. In short, it targets countries with zero or low taxation, effective taxation. It targets tax incentives and preferential tax regimes. Pillar 2 addresses remaining BEPS challenges, as I have said, and is designed to ensure that large internationally operating businesses pay a minimum level of tax regardless of where they are headquartered or the jurisdictions they operate in. It does so via a number of interlocking rules that seek to ensure minimum taxation. And the principal mechanism to achieve this outcome is the Income Inclusion Rule, IIR, together with the Undertaxed Payment Rule, UTPR, acting as a backstop. The operation of the IIR is, in many respects, similar to that of a traditional controlled foreign company, CFC rule, and triggers an inclusion at the level of the shareholder where the income of a controlled foreign entity is taxed at below the effective minimum tax rate. The IIR and UTPR use the same rules to determine scope and the level of effective taxation. They apply to MNE groups and their constituent entities within the consolidated group as determined under applicable financial accounting standards. They only apply to businesses that exceed a 750 million euros annual gross revenue threshold. This creates synergies with the current BEPS Action 13 country-by-country reporting rules, thereby reducing compliance costs. But I want to stress this: countries can apply a threshold below 750 million euros. What I want to say also, in terms of carve-outs, yes, there is a carve-out for sovereign wealth funds, for investment funds. There are some carve-outs, important carve-outs, but the carve-out related to the Action 5 is not recognized under the Pillar 2. And there was a huge debate between countries on why this is not admitted and accepted under the Pillar 2, but I guess that the blueprint, which will be published very soon by the OECD, will say clearly that this carve-out will not be admitted.
So thank you, Mr. Lofty, for the intervention and answering some of the questions. Unfortunately, we would have to end the webinar. We're short beyond the time allocated to it. But just to say that apparently there are many conversations to think about, and when you think about taxation, you're looking at, again, as has been mentioned, the impact on foreign direct investment, the sort of the behavior of multinational enterprises as the rules evolve. And we're sort of in an era where we're not certain what the rules will be with Pillar 1, with Pillar 2. And even though there are blueprints that have been shared, and we look forward to what will be decided in October or discussed in October, there are many areas for studies, as Mr. Loftier sort of mentioned. One from analyzing the relevance of these global reforms to countries and whether countries should participate in them, but also the fact that we're in a world where if we're not able to agree on sort of a consensus, then there'll be a lot of unilateral measures by countries, and there's a fear of trade and tax wars, as we've already seen with France and the US and many other countries. Just to say that we're very grateful from the College of Law, HBKU. We're grateful for everyone's participation and engagement. I'm personally grateful to all the speakers. It's been months of planning. It's been months of fine-tuning the topic, the theme, and I've actually ended up, enjoying the conversations that we've had before now. But even to this conversation has been more enriching. And I really want to thank you. I also thank my colleagues at HBKU. I thank the Dean for our support. I thank Mr. Ezzeddine, Sandia, and everyone who has helped put this together. And again, thank you to everyone, and thank you for listening. Till next time, we're very grateful for this. Thank you.